What's up, people out there in the crypto world? This is Steve from Altcoin Buzz, and we're going to cover some information you need to know about cryptocurrency and taxes, so stay tuned. All right, welcome back to another adventure. This is Steve, and we're going to dive into some information that you're going to need to know about taxes. You may or may not have already filed your taxes for 2017, but it's okay because you need to know this information for the rest of the year because it's definitely going to affect you next year in 2018 when you go and file those taxes. So know this information beforehand before you go about making purchases, trades, and sales of your cryptocurrency. All right, so the market's been pretty good lately. Back to back, we've had a few gains this week, single-digit, double-digit gains. People are making some moves on Litecoin, starting to take some profits, it appears. Don't blame them because, a few days ago it was down $60 from now. So it's looking pretty good. But overall, market conditions are doing pretty well. But this is one of those things that you have to be aware of. And I want to clear up a couple misconceptions about how taxes are supposed to work. But I want to tell you before I get into it that it's not financial advice. I'm not a financial advisor. I'm not a certified CPA. So it means I'm not a tax accountant. I'm just an average Joe, just like you. Happen to, of course, be on a YouTube channel talking about cryptocurrency, but I'm only telling you what I've discovered, and I may or may not be wrong, or right. So feel free to correct me in the comments if you have some further input. Also, if you are a tax professional and you'd like to provide some links to relevant information that people can read up on to learn a little bit more than what I would cover, because this isn't going to be fully comprehensive, please feel free to make comments to that down below. We definitely appreciate the information from the community and people looking out for each other. So with the market going up, what this could mean is that you might be subject to some taxable income for next year. If you purchased some cryptocurrency in the past, which presumably you have, you're here. If this is your first time on our channel, by the way, hit the subscribe button, click the bell next to it for notifications. That way you can get more videos like these and we publish those in the future. And if you prefer other platforms, we're also on Twitter at AltcoinBuzzIO. We're on Instagram at AltcoinBuzz, and you can check us out on Facebook. We're called Altcoin Buzz on Facebook. Shameless self-promotion there, but hope you guys are following along quite nicely. So with these capital gains that you need to be worried about, and I say worried about because it needs to be on your radar, and we don't want to be in the habit of withholding this information when we go to fill out our taxes. After all, gains are gains, and you got nice gains, bro. So this is something that we want to make sure we're on the up and up, and we report so that way people aren't abusing this situation for their benefit, meaning that more regulation is going to be forced upon us in the future down the long term. So the other thing that makes this tricky is that none of the exchanges are actually required to report to you any of the necessary forms that would tell you what your gains are. So they could be tracking it for you in theory, right? They keep all that information on the back end. They know their customer. They verified your identity. So a lot of times if you're in the US, they have your social security number or their identifying number. So they could do all this for you and provide you a nice clean statement at the end of the year, but some people would dread that. The only people that really would are those that are withholding that information. So let's go ahead and talk about one of the biggest misconceptions. So one of the biggest misconceptions that I've seen in cryptocurrency is that people are saying incorrectly, at least based on my findings, that if I go ahead and buy Bitcoin and then I go and I trade that for Ethereum, and then during that trade I make or lose money, that's the tax, that win or loss is a taxable event, and then I sell that Ethereum, that I'm going to have to pay taxes on that entire amount, right? So for an easy example, in their world, I would be putting $1,000 into Bitcoin. I would be trading that for Ethereum. Let's just say it's an even trade, so there's no win or loss. So I end up with $1,000 of Ethereum, and then later down the line, I go ahead and I sell that same $1,000 of Ethereum for a flat $1,000. Some people have the misconception that you would be paying income taxes on that $1,000 as if you somehow magically went and made that $1,000 appear out of thin air. And that's not the case. If that's the case in that specific example, you have $0 of tax liability based on my findings. That would mean that you have gained nothing and you've also lost nothing. So you wouldn't be able to claim anything on your itemized deductions against your other earnings. So trading one cryptocurrency for another and then selling that other cryptocurrency does not make all of that value a taxable event. So let's look at Forbes.com, and then we're also going to look at the IRS.gov for some information from some more official sources rather than just your homeboys here at Altcoin Buzz. I appreciate the love. Go ahead and smash that like button because that's what keeps people engaged. That helps refer this video to other people who are interested in cryptocurrencies out there. There's an algorithm behind it, just like in the back of our heads. We're always trying to process things. They're trying to think smart and recommend this. The more likes we get in a ratio of people that watch this video, the more likely it is to recommend and bring more people into the fold so we could grow this altcoin army. So we really, really, really appreciate you guys out there. So this is from, let's give her credit, this is from Kelly Phillips Herb. She's got the herb. And what she wants to know is to tell you some information. So I can drop a link to this in the video. That way you guys can read this. And it talks about what a basis is. And in a nutshell, a basis is basically what you pay for a good or service, some inventory that you're going to sell. In this case, a stock or cryptocurrency. And that basis can change over time because it's a rolling average of what you've paid for something. So let's say you go in, your dollar cost averaging, because that's how it actually pretty much works, and you go buy $500 worth of Bitcoin. Your basis there is $500 worth of Bitcoin. And that basis can be calculated versus the volume that you purchase. I don't want to assign a volume because that would get complicated, but you've got point something Bitcoin for $500. And then later on, you go and you buy $500 more worth of Bitcoin, and that's Bitcoin's gone up, right? Presumably, so you bought slightly less. Well, what you're going to do is take that $1,000 total that you've put in, divide that over the point something that you have now in Bitcoin, and that is going to be your basis for what a point something of a Bitcoin is worth when and if you trade it and sell it for a gain or a loss. So that's, in a nutshell, hopefully not too complicated, what a basis is, because you may or may not sell or trade your entire holdings at any given time. All right, so you're not taxable on it if you hold it. So holding it and realizing gains at the end of the year, if you bought, let's say you put all your life savings into cryptocurrency and you never sold a dime of it, and at the end of the year you're up massive big time gains like you would have been in December of last year, you don't owe any taxes on it because you haven't actually sold anything or traded anything, so you haven't realized any gains yet. Just like if you're down and you've lost a ton but you haven't sold, you're not qualified to make any claims for any type of deduction. So the taxable event is really, we no longer can take the shelter of what used to be considered a like-kind exchange. And a like-kind exchange meant that you traded one thing for something that was exactly like it. Now, sending your Bitcoin from like Coinbase to an exchange is not a taxable event because you're not moving the coin. But what you want to keep track of are some of the fees that you're paying for that transfer. So, and this is really tricky, right? This is in an ideal world, you're somehow tracing all this. But the fees you acquire to pay to buy that cryptocurrency, like that Bitcoin on Coinbase, those come out of your basis. So you're going to subtract the fees that you paid out of the cost, so your basis goes down. But then when you trade, you're going to want to keep track of those because you're going to be able to deduct a certain portion of those against your taxable earnings. And that is something you want to keep track of because to your benefit, if you lose track of those, if you don't keep track of them, you're not going to be able to claim them. So try to keep as best of a log as you can. And if you've got some suggestions on different apps and things you can use to track your trades or different things that plug into APIs, recommend those down below in the comments as well for the benefit of everybody. We'd love to check those out. So don't just take Forbes' word for it, but they definitely seem to be very credible, at least in the business and financial world. So here's what they say about what happens if you lose money, that you can claim up to $3,000 if you're filing jointly with somebody else in losses, capital losses specifically. And that's not just cryptocurrency, that's all holdings. That could be real estate, stocks, bonds, and cryptocurrencies and other things that are similar. Or if you're by yourself, if you're one of those lonely dudes out there in the crypto world, then you're only going to be able to claim $1,500. And that's not very much, right? People were losing big time during January. So if you were one of those weak hands that had purchased something and you jumped on the bandwagon in December, bought things at all times high, and then you believed all the FUD down in early to mid-January, late January, and you thought the sky was falling, is never going to get any better than that, and you cut your losses and sold for massive losses, hopefully you didn't lose more than $1,500 to $3,000. That way you can write that off towards your normal income that you have during the year. So let's keep that in mind. You want to try to mitigate losses. Obviously, we're not in this to accept losses, but it's an inevitability of what you want to be aware of in any sort of investment. That's why you don't invest more than you can afford to lose. And if you can try to control it, it's really outside of your control unless you're the whale in the market or one of the whales in the market, then you just really have to ride the wave, right? You're a minnow at that point. So take a look at that. I will link to that article. But here is, at least for the 2017 year, so this won't apply to next year's taxes necessarily because tax laws tend to change year to year. But this will apply if you're still waiting to file your 2017 taxes. So this is instructions for a Schedule D. Maybe not everybody has to fill these out, but this is a certain type of schedule in addition to a normal 1040 that you would want to fill out. And oftentimes, if you're filling out these types of forms, you won't be eligible for the free tax services from things like H&R Blockchain and TurboTax and stuff like that. So that is something you want to keep in mind. You're going to have to do a little bit more of your Dewey Decimal work there and keep track of stuff. So here's the general instructions. I won't read through them because the IRS is known for being boring, in addition to wanting to get their little dirty dick beaters onto all of you guys' little capital gains and assets, which is why they've got their hand in your pot right now, because they realize that there's a significant amount of money of which they can do a cash grab for. And when you're in the taxi cab doing the cash cab, you want to do the cash grab as quick as you can. So this is how they normalize capital gain or capital assets. There's something to know about short-term and long-term gains or losses. So if you've been holding something for more than a year, very unlikely for most of you guys in cryptocurrency, at least at this point, you wouldn't be able to count it as a long-term gain. If you hold it for less than a year, then and you sell it, it's considered a short-term gain or loss. So that's just something you guys want to be well aware of. Now, we won't assume you're selling your home. Please don't mortgage your home for cryptocurrency. Please don't go live on the streets either. But that is something you guys want to be well aware of. So just read through this. I'll definitely link to this into the, this is for the 1040D, Schedule D. This is the instructions on how to fill out the friggin' form. I will link that for you guys. So there's the form itself, which is never fun to fill out, but you're going to want to fill that out too. So I just want to dispel that big myth that I've had people say like, oh, you're trading this for this. You've already lost more than you've gained just by trading Bitcoin for Ethereum. You know, you're going to get taxed 30%. If you haven't made at least 30% gains when you go to trade, you're going to basically be paying the government and all this stuff. So unless one of you guys has some solid proof otherwise, that is definitely not the case. So don't be spreading that misinformation out there. Definitely talk to a tax professional, not the people with tattoos and facial piercings that are doing taxes at Walmart, but those guys somewhere else that are actually more professional. If they're wearing a suit and tie, make sure the tie is probably like tied on and not a clip on, unless they have problems with their circulation and things like that because they've been in their chair kicking ass on the tax system. But yeah, so basically, I don't want you guys to be afraid of making money. You know, Jeff's talked to his accountant many times in the past, and one thing I've heard his accountant say is never let making money get in the way of making money, because everything will work itself out in the end, right? If you are making money, then you have the means to pay the taxes. If you're too afraid of making money because you don't want to pay the taxes, then you're going to self-fulfill that prophecy and you're going to be unsuccessful. You've already established a fear of success at that point, and you've let other people rule your decision to make money. Take control of the situation, get out there and make as many gains as you possibly can. But just like playing a good game of blackjack at the casino, you got to realize that despite what you know about the rules, when to hit, when to fold, when to double down, things like that, that you need to walk away from the table when the time is right. And we don't always perfectly time that, but you need to be satisfied with when you walk away from the table, aka cash out. And it may or may not be the times you could have made the most. The woulda, shoulda, coulda will kill you guys if you let that eat you up, because, you know, I've traded cryptocurrencies and then seen those cryptocurrencies like shoot to the moon thereafter. But I was happy with less gains, right? But everyone else is like, oh, you sold your whatever, and then, you know, you could have been like whatever. You made a big mistake. Well, I'm not mad at myself. I never get mad about making money. And if there ever comes to a point that I have to realize that I'm going to lose money, it's an inevitable, right? If I stay in the market long enough, I'm going to lose money in something. Hopefully not everything. But that's something you also have to be willing to accept. You know, you could be the bag holder holding the last bag as everyone else is leaving a coin, and you can see that coin get de-indexed, get delisted, the business go under, and then it become nothing to speak of. And that's going to happen to somebody, right? Happens to people on Wall Street, happens to people on crypto, happens to people in real estate. It's just the way of life. We're dealing with, when we go back and we look at that market capitalization, that $484 billion that's listed there, and we'll even refresh that to see if it's gone up or down. It's up. Okay, cool. Celebrate, pop the bottles, have a Diet Coke or something like that. But that's not a deposit. It's not the amount of money that's in there. So it's an inflated number, and it's not meant to be misrepresentative, but it works off the same calculations as the tax system. So there's not $485 billion sitting in the accounts waiting for people to cash out. It's taking the trade volume in the last rolling trade price, calculating it towards all tokens on the market, of which we know not everybody paid the same amount for. It's not a dollar cost averaged version of what we've paid into the cryptocurrency space. Anyways, guys, you stay smart. Comment below what you'd like us to talk about in the future. This is Steve from Altcoin Buzz, and looking forward to tomorrow when we can do some crypto and cognac or something fun like that. It's going to be Friday night.